Matter of fact, you can have $500,000 of home equity and still be 1.7 months away from losing control of your next housing decision. You own a house worth $700,000. The mortgage balance is $200,000, so the house contains $500,000 of equity. You also have $200,000 in retirement accounts and $24,000 in cash. Your total net worth is $724,000. Then a roofer gives you a $14,000 estimate. You can pay it. That is not the problem. The problem is what remains after you pay it. Your essential expenses are $6,000 a month. $24,000 in cash appears to cover 4 months. Plenty of homeowners would look at the account, look at the equity, and conclude that this is annoying but manageable. The useful number is not raw cash months. It is adjusted liquidity months. Take the cash and safe near cash you hold outside the house. Subtract known home capital costs likely to arrive during roughly the next 24 months. Then divide what remains by your essential monthly expenses. For this house, that means $24,000 minus the $14,000 roof divided by $6,000. The result is about 1.7 months. Brief pause. You did not become fragile when the roof estimate arrived. You were already below the line. The estimate exposed it. For a practical diagnostic, fewer than 3 adjusted months is the operational cash poor line. 3 to 6 months is a rebuilding zone. 6 months is a stronger target when replacing your income could take time. That is not a universal law. A household with 2 stable pensions has a different risk profile from a household dependent on one specialized late career salary. Home equity concentration is also not enough to diagnose the problem. A large equity share is a warning light. Adjusted liquidity tells you whether the car is currently losing oil. Your second calculation is the minimum outside the house cash floor. Add your known near-term home capital costs to 3 months of essential expenses. The roof is $14,000. 3 months of expenses is $18,000. Your minimum floor is $32,000. You currently have $24,000. So despite a net worth above $700,000, you are $8,000 below the minimum before the roof has even started leaking. A more resilient 6-month target adds $36,000 of essential expenses to the roof reserve. That produces $50,000. You are $26,000 short of that stronger position. This is the distinction housing folklore tends to blur. Your equity is real wealth. It may reduce future housing costs, support a later downsize, become part of an inheritance, or provide borrowing capacity. It does not perform the same job as cash that can fund groceries, insurance, utilities, and a mortgage payment this month. That distinction affects a lot of normal homeowners. An analysis of census data found that home equity accounted for a median 45% of homeowner net worth in 2021. Concentration in one address is common. It is not evidence of failure. The Federal Reserve's latest household survey, covering 2025, found that 63% of adults could handle a $400 emergency using cash or its equivalent. Yet, only 55% had set aside enough for 3 months of expenses. Those are different tests. $400 asks whether you can absorb a small hit. 3 months asks whether you can survive a prolonged interruption without needing a lender, a buyer, or a retirement account withdrawal. And a home creates a third test. Because some of your cash already has an assignment even when it is sitting in the same savings account as your emergency fund. Fannie Mae gives homeowners a broad maintenance planning range of 1% to 4% of the home's value per year. On a $700,000 property, that would be $7,000 to $28,000, which is too broad to be useful by itself. It can also exaggerate the number in expensive markets where much of the property value comes from land rather than the structure. So you refine it. You look at the age and condition of the roof, heating and cooling equipment, plumbing, exterior, and any association assessments. You estimate current replacement costs in your market. A $14,000 roof is comfortably within published 2026 national replacement ranges, but your actual estimate matters more than a national average. The roof is not an emergency. In the same way, an unexpected job loss is an emergency. It is an aging component with a partially visible deadline. Freddie Mac's homeowner guidance even uses a roof replacement expected within a few years as an example of something that belongs in your savings plan now. Once a cost becomes foreseeable, you stop counting that money twice. You cannot say the $14,000 is available for the roof and also claim it can fund your living expenses after an income interruption. $1 can have two labels in a spreadsheet. It cannot pay two bills. By the way, if this kind of housing math is useful, subscribing helps Lazy Investor reach more people. I appreciate everyone who does. Now, the roofer gets paid. Your cash falls from $24,000 to $10,000. Your home value may still be $700,000. Your mortgage remains around $200,000. Your retirement account still shows $200,000. Your net worth has barely changed because maintaining the property may preserve its economic value, but your liquid position has changed completely. This is what breaks first when you become house rich and cash poor. The reserve outside the house gets consumed. Not the house, not the net worth statement, the money that allows you to wait. Interestingly, your adjusted liquidity clock still reads about 1.7 months. Before the repair, you had $24,000 minus a $14,000 obligation. After the repair, the obligation is gone and $10,000 remains. Same runway. The cost moved from the future into the checking account. Paying cash for the roof was responsible. It also revealed that the emergency reserve had actually been the repair reserve. The next question is how long $10,000 protects your choices if replacement income pauses. The usual 3-month emergency fund rule sounds reassuring because the median unemployment spell is shorter than 3 months. Bureau of Labor Statistics data for 2025 put the median duration at 9.9 weeks. The mean duration was 23 weeks, or roughly 5.3 months. Long job searches pull that average upward, and more than 23% of unemployed people had been looking for at least 27 weeks. This does not mean you should expect to be unemployed for 5 months. It means the median is a poor expiration date for your savings, especially when you are late in your career, highly specialized, geographically constrained, or unwilling to accept a major pay cut. At $6,000 of essential spending, the $10,000 remaining after the roof covers the first month and leaves $4,000. Before the second month ends, the cash reaches zero. No second broken appliance is required. No divorce, medical crisis, storm, or cinematic disaster. One foreseeable repair, followed before the reserve is rebuilt by one interruption in income, is enough. This is a timing stress test, not a prediction. The value is seeing the order in which control disappears. At first, you pause discretionary spending. Then retirement contributions stop because the checking account needs the cash. If the interruption continues, a retirement withdrawal, credit card balance, deferred bill, home equity loan, or property sale enters the conversation. Each option can produce money. None is equivalent to having owned liquidity before the problem started. Slows down. Freeze the balance sheet. At the moment, cash reaches zero. The house still contains close to $500,000 of equity. The retirement accounts still contain roughly $200,000. On paper, you remain a wealthy household. Yet the next $6,000 month cannot be funded without a transaction. This was never mainly a net worth problem. It is a maturity mismatch. Your largest asset may be designed to serve you for decades. Your bills mature every 30 days. Converting the asset can require underwriting, interest, tax consequences, market exposure, contractors, buyers, inspections, closing documents, or a move. Solvency answers whether your assets exceed your debts. Liquidity answers whether you can pay on time without surrendering something else. You can be solvent, wealthy, and cornered at the same moment. The obvious rescue is the $500,000 of equity. Mortgage data provider ICE reported in 2025 that qualified mortgage homeowners with tappable equity held roughly $212,000 of it on average. It is not. It means the equity could potentially support borrowing while maintaining a lender-defined cushion, usually subject to credit, income, property value, combined loan-to-value limits, and underwriting. An unused HELOC can be valuable backup capacity. It is still a variable rate loan secured by your home. In late July 2026, the national average HELOC rate was about 7.43%. At that rate, a $14,000 balance creates roughly $87 a month of interest before meaningful principal repayment. A $50,000 balance creates about $310 a month of interest. That may be a rational price for a temporary bridge when you know how and when the debt will be repaid. It becomes dangerous when borrowed money funds an open-ended monthly gap with no replacement income date, and the rate can move. The Consumer Financial Protection Bureau explains that HELOC lenders may reduce or freeze additional access if the property value falls significantly or the borrower's financial circumstances deteriorate enough to threaten repayment. Notice the timing. The moment when you most need the line may also be the moment when your employment, credit profile, or home value looks less attractive to the lender. That does not make a HELOC a bad product. The mistake is placing unused credit in the same mental category as owned cash. Cash does not require permission after the emergency begins. A new loan does. Maybe you avoid the HELOC and refinance the first mortgage instead. That can create a larger lump sum, but it also replaces the existing loan. The average 30-year mortgage rate reached 6.69% in early August 2026. The pandemic-era record low was 2.65% in January 2021. That is a difference of about 4 percentage points. If your current $200,000 mortgage carries one of those low rates, a cash-out refinance does not borrow only the emergency money at the new rate. It can reprice the existing mortgage balance as well. You solve a cash shortage by making the entire housing debt more expensive. That rate lock-in helps explain why more homeowners have turned towards second liens instead. New York Federal Reserve data showed HELOC balances rising for 16 consecutive quarters through the first quarter of 2026. Again, that can be sensible financing. It also shows how a balance sheet rich in equity can produce a growing debt payment when the household needs cash. Selling converts the equity more directly, but the sale has its own clock. You need time to prepare the property, choose an agent or selling method, evaluate repairs, negotiate, close, and arrange the next place to live. When your adjusted liquidity is 6 months, you can reject a weak offer, compare replacement homes, and decide whether the low mortgage rate is worth keeping. When your adjusted liquidity is 0, the buyer knows something you would prefer not to advertise through your behavior. You need the transaction more than they do. The price may not collapse. Force does not always mean foreclosure or a dramatic discount. It can mean accepting an inconvenient closing date, paying for repairs you would have negotiated, moving twice, choosing the available rental instead of the suitable one, or selling retirement assets at a bad time to cover the gap before closing. What deteriorates is control over timing. Traditional net worth accounting does not show that clearly. It counts $1 of cash and $1 of home equity in the same total. Both increase net worth by $1. Only one can fund this month without a loan or sale. That measurement problem becomes more important near retirement. The Joint Center for Housing Studies at Harvard reported that in 2022, 31% of homeowners in their 80s and older still had a mortgage. Debt in later life is not automatically a mistake. A low fixed-rate mortgage can coexist with a strong portfolio and reliable income. The point is that the house will be paid off is not an emergency liquidity plan. Later still requires a date, a market, a destination, and enough cash to reach the closing table without panic. A balance sheet measures what you own. It does not measure how long you can refuse a bad offer. A quick thank you to everyone subscribing to Lazy Investor. It helps more than you might think, and I'm grateful you're here. The repair begins with one number, your minimum outside the house cash floor. List the home capital work reasonably likely during the next 24 months. Not every theoretical problem. The items with visible age, condition, bids, inspection findings, or scheduled assessments. For this household, the roof contributes $14,000. Then calculate essential monthly expenses, not total lifestyle spending and not a fantasy austerity budget you could tolerate for 4 days. Include the mortgage, property tax, insurance, utilities, food, healthcare, transportation, and minimum debt obligations. That number is $6,000. 3 months contributes $18,000. Add the roof, and the minimum floor becomes $32,000. Your current cash is $24,000. So new savings flow to the $8,000 shortfall before money goes toward a kitchen upgrade, landscaping project, larger home, or extra mortgage principal. Paying additional principal may increase equity and reduce future interest. It also sends more money into the asset that already cannot pay your current bills without a transaction. The order matters. Build the outside the house floor, then decide whether the next dollar belongs in the mortgage, the portfolio, or the property. After reaching $32,000, this household is no longer below 3 adjusted months. That is progress, not invincibility. A late career worker with one major income source may continue toward $50,000, $14,000 for the roof, plus $36,000 for 6 months of essential spending. Keep the maintenance reserve and emergency reserve conceptually separate, even if both sit in safe, liquid accounts. One protects the physical asset, the other protects the household's income gap. Combining them is how $24,000 starts looking like 4 months when it is actually 1.7. Retirement assets remain outside the house, but they are not automatically safe near cash. Selling investments during a market decline can lock in losses. Withdrawals from tax-deferred accounts may create taxable income, and age or account rules can add complications. Most importantly, money removed from retirement stops performing its original job. The reserve should be boring. Cash, insured deposits, treasury bills, or other safe near cash appropriate to your access needs. The objective is not maximum return. It is preserving the ability to wait. Once the reserve is rebuilt, a HELOC can return to its proper place, backup borrowing capacity. You may establish one while income and credit are strong, compare terms, and leave it unused. But the adjusted liquidity calculation still uses owned cash, not the credit limit. If the house continues to represent too much of your wealth, rebuilding cash may not fix the long-term allocation. $500,000 of equity divided by $724,000 of net worth means about 69% of your wealth is tied to one address. That percentage is a concentration signal, not an automatic sell order. The home provides shelter, stability, control, and perhaps a low fixed housing payment. Those are valuable. A household with secure income and $50,000 outside the house may be comfortable with that concentration. A household approaching retirement that expects the home equity to fund spending faces a different issue. The equity cannot support retirement withdrawals while also remaining fully committed to the same house forever. That is when a staged downsize becomes an allocation decision rather than an emergency response. You do not wait until the checking account is empty. You begin while you can inspect the replacement market, estimate selling and moving costs, complete necessary repairs, choose the destination, and decide how much capital the move would actually release. A smaller property does not release the full difference between two listing prices. Selling costs, purchase closing costs, moving, repairs, renovations, taxes, insurance, and association fees all matter. You calculate the net cash released and the new annual carrying cost. If the transaction frees substantial liquid capital and lowers future maintenance, it may improve retirement resilience. If a costly replacement property and high association fees absorb the equity, the smaller floor plan may not improve the financial scorecard. The downsize works when it changes liquidity and ongoing costs, not because smaller sounds responsible. And it works best while it remains optional. Federal Reserve survey data show that about 7 in 10 adults aged 60 and older have 3 months of emergency savings. So rebuilding a usable reserve later in life is neither unusual nor an admission that you mishandled the house. It is a normal act of assigning different jobs to different assets. More seriously, picture the same homeowner in 2 versions of the next year. In the first version, the roof is paid and cash falls to $10,000. Income stops before the reserve recovers. Within 2 months, ordinary bills require borrowing or asset sales. A contractor's financing offer, a lender's variable rate, a retirement withdrawal, or a buyer's timetable becomes necessary. The homeowner still has nearly $500,000 of equity. The wealth did not disappear. The acceptable choices did. In the second version, the homeowner reaches $50,000 outside the house before the interruption. $14,000 pays for the roof. $36,000 remains, covering 6 months of essential expenses. The property value is the same. The mortgage is the same. The equity is the same. But now you can wait for replacement income. You can compare a HELOC with selling investments rather than taking whichever source answers first. You can reject expensive contractor financing. You can pause a downsize if the replacement market is poor, or proceed gradually if the allocation no longer fits retirement. The reserve did not make the house more valuable. It made your timing more valuable. This is why the first thing that breaks is liquidity. Then repair timing becomes inflexible. Continued income interruption puts ordinary bills onto credit. Credit pressure can damage borrowing terms. Retirement contributions stop, or assets come out early. Finally, the housing decision itself moves from voluntary to urgent. The cascade is not driven by low net worth. It is driven by having too few assets that can perform the next 30 days of work. The house is either a wealth decision or a lifestyle decision. Pretending it's both is how the math breaks. You can choose to own more house because it improves your life. You can choose to keep a large equity position because it lowers future housing risk. The protection fails when every spare dollar goes into the property while the household reserve is expected to cover maintenance, unemployment, and every other interruption at once. For this $700,000 house, $32,000 is the minimum outside the house floor, and $50,000 is the stronger 6-month target. The current $24,000 is not 4 months of safety once the roof is recognized. It is 1.7 months. The house did not make you poor. The absence of time stored outside the house made you fragile, did not make you poor. The absence of time stored outside the house made you fragile,